Good morning, ladies and gentlemen. Thank you very much for making me here so early this morning to join our Global Trade Forum. Well, I'm very happy today for being able to introduce to you Dr. A Krueger from Johns Hopkins University as today's guest speaker. Well, I guess some of you may remember that we actually had Professor Krueger last year, about a year and a half ago. That time was in the middle of the deep crisis and running into its peak. In that speech, Dr. Krueger reviewed carefully on the causes of the global economic crisis and suggested some policy remedies and provided some outlook for short-term and more longer-term. Well, she said at the time the short-term outlook is not bad, in fact, maybe good, but the longer-term outlook is somewhat gloomy. Probably we are in the middle of the longer-term turmoil at the moment. And today's her speech, the topic of the speech, is again about the global economy. Where do we stand? So I think that today's speech is more or less like a sequel to last year's speech. And she will cover, I think, whatever happened between then and now in terms of policy arena, as well as real sector responses. And I think she will make a careful review on the current state of the global economy and try to identify major issues that the global economy may confront now, probably now and in the future. And then I think she will provide again, once again, about the picture of the global economy now in the coming years. But in order to save time, because she is very tight scheduled this morning, I'll be very brief in telling you about her brilliant career. In the first place, I think she is probably the only person who served both for the World Bank and for the IMF at the highest level where the economy can reach. In the first 5 years of this century, she served as first deputy managing director for IMF for 5 years, and in the early 1980s, she served for the World Bank as again vice president and chief economist for 4 years. And before that, she started teaching at the University of Minnesota right after her PhD from University of Wisconsin in the late 1950s. Yes. She spent almost 20 years there, and there she earned academic fame and world reputation, I guess, until she recruited by the World Bank in the early 1980s. And then after World Bank, she moved to Duke University and Stanford University. While she was working with the Stanford University, she served also as president for the American Economic Association. Well, as I said, since she has a very tight schedule, I would skip all the literature and articles and books she had made so far. But I will certainly have another opportunity to tell about it. Last year, I already talked about it quite a bit. So now, let me present to you Dr. Krueger for today's speech. Please join me for welcoming her.
Thank you very much for that nice warm introduction and welcome. It's always a pleasure to be here. I enjoy being in Korea and learning more about Korea's extraordinary progress and observing the tremendous strides that are being made. But this time it's actually an additional pleasure because Korea, and Asia more generally, is the part of the world that is performing best economically at the moment. It's nice to be in a place where the general outlook is more upbeat than it is in some of the countries where I've been recently, and in some of the countries that have had a more serious downturn and a slower turnaround from the recession. Yesterday I was at the conference on the 60 years of Korean economic growth, and I must say that much as I thought I knew quite a bit about it, when one looks back on what's happened here, it is truly remarkable, and I hope everyone in the world can learn from Korea and what the Korean achievements are. As Dr. Nam said, my topic today is the global economy and where we stand. There are always uncertainties in the economic outlook. Nobody can ever be sure. And there are always both positive and negative factors that have to be weighed. But this is a time when uncertainty is about as great, if not greater, than it has ever been with regard to the future of the world economy. So what I want to do is start today with a brief reminder of the factors that contributed to the Great Recession, as it is now called. For those factors not only contributed to the initial plunge in economic activity, but the downturn was so steep that it complicates efforts to analyze what is happening at the current time, because the beginning of the upturn was bound to be a little bit steeper than normal as a result, which meant that things were going to slow down a bit as a result of that. And so there's more to factor in simply on that account. After I've done that, I want to draw attention to the characteristics of the downturn that made it so very sharp. For those characteristics, too, make the interpretation of the current situation more difficult. With those factors in mind, we can then turn our attention to the first year or so of the recovery, i.e. up to the present. As you know, the recovery was certainly stronger and quicker than most analysts forecast a year and a half ago. And at present, the upturn is slowing down, which then raises questions in everyone's mind. To what extent is the downturn a temporary pause, or are we likely to see, as it's called, a double dip recession where economic activity could actually start falling again? Finally, I shall turn to the longer-term outlook. While that too is uncertain, the latitude for policies to influence the outcome and the predictability of the issues are unusually greater than in the short term. Usually we know more in the short term and more uncertain. This time it's the other way around. Well, let me turn then to the factors contributing to the downturn. The global downturn actually started in the real economy as the construction boom, especially in housing, faltered. In a few countries, perhaps most notably Australia, the monetary authorities tightened policy as early as 2003 as housing prices were rising what they thought was too rapidly. And that cooled the housing boom at the time there, and Australia has not had a single quarter in which economic activity has dropped in the entire period since the beginning of the global downturn. But in most other countries where the boom, or bubble as some call it, was underway, the authorities were monitoring the overall level of economic activity and inflation, but they did not intervene in response to the run-up in housing prices and real estate costs. To this day, there is a major argument going on among monetary theorists and monetary policy types as to what the appropriate response of a central bank is, or should be, when there are housing prices or some other asset bubble at the same time as real economic activity looks fairly stable and inflation is not rising. It is a problem, and it has not as yet been resolved, even as to what one should do in future cases when that kind of thing happens. When prices stopped rising, as they inevitably had to, the repercussions were immediate. The demand for housing fell right away because some had been buying in anticipation of future price gains, and when that stopped happening, speculation ceased, and construction activity turned down rather sharply and rather quickly. In the United States, housing prices peaked in the summer of 2006, and economic activity began to slow. But it was not until March 1997 that the first headline signs of trouble in the financial sector appeared with the failure of Bear Stearns. It should be remembered, of course, that there were other institutions in other countries that had failed even earlier, Paribas in Paris, Northern Rock, and so on. It was not a unique American phenomenon. But throughout the summer of 2007, there was additional evidence of difficulties in the financial sector, continuing slowdowns in real economic activity, and especially where construction was involved, those slowdowns were reported. During that period, business journalists forewarned of the onset of a recession, although national income accounts continued to show modest increases, albeit very small ones, in the level of economic activity both in the United States and Europe. All of that changed abruptly in early September, however, when Lehman Brothers failed. That failure sent shockwaves throughout the international financial community and started an abrupt decline as contrasted with the very gradual sorts of events that had been happening earlier. There were a number of reasons for the huge reactions. First, there were questions as to why Bear Stearns and AIG, the largest insurance company, had been rescued, while Lehman Brothers had not been saved by the Fed. Lehman Brothers seemed to be one that was a natural candidate for being saved, and Bear Stearns seemed less obvious, although it does turn out there were some reasons. Second, there were serious concerns that other financial institutions, which people had earlier thought were entirely creditworthy, might also be in difficulty. After all, if Bear Stearns and these AIG went, what was to stop others from going too? And because members of the financial community and others could not understand why the Fed had allowed some institutions to fail and rescued others, there was great uncertainty as to what other financial institutions might be left to collapse. This in turn resulted in an unwillingness of all financial institutions to lend to each other, even overnight, which is crucial for the functioning of the financial system. The financial system virtually froze completely. The result was a serious partial paralysis. Thirdly, as the extent of that paralysis became evident, consumers and investors pulled back sharply for fear of what else might happen. So you had the construction falling first, then you had the financial reaction, then you had consumers and businessmen pulling back their expenditures because of the financial, so in the sense it was a self-reinforcing downward spiral. Then the question comes, why was the downtrend so steep? The downturn began almost simultaneously in several countries, but it was the sharp turn in economic activity in the United States that dominated perceptions of the global economy. For that reason, I'm going to focus on that in discussing why the downturn was so steep, commenting on events in other parts of the world, only where there are significant differences or important factors that need to be mentioned. It had earlier been recognized that American consumers, especially, had been saving very little, and indeed had been saving in some periods prior to 2006. Many consumers had refinanced mortgages at very low real interest rates using, as some people put it, their home equity as an ATM machine. They basically would get some appreciation in the housing price, they would then borrow against that equity, they would then spend that on other goods, and that was why the savings rate was so negative. When housing prices started falling, home equity loans dried up, consumption expenditures fell as consumers could no longer sustain this additional expenditure. Once that happened, of course, businesses feared for their future sales and began reducing inventories and cutting back on their investment plans. The cut in inventories was especially sharp and pronounced and came on more quickly than it had in past recessions. So all domestic sources of demand, construction, inventories, consumption, business investment, all fell abruptly within a very short period of time. As that happened, the panic imparted by the financial system's misfortunes was intensified. The downturn was, of course, then very pronounced, more so than had been the case in any earlier recession in the post-World War II period, and probably even before that if we had good enough records. As you know, the volume of world trade dropped very, very sharply, again, much more so than earlier. And although the reasons for that very sharp drop are not yet fully understood, it appears that business cutbacks on inventories with a consequent failure to place new orders were a major factor. Further intensifying the reduction in trade volumes, trade credit seem also to have shrunk disproportionately as the financial difficulties affected all types of credit and there simply was not trade credit available in many cases. Now, in any downturn, consumption falls as unemployment rises, as average hours worked drop, and as lower incomes lead to cutbacks in consumption. But in the Great Recession, the cutback in consumption was considerably greater than could have been accounted for by job losses and reduced hours. Even consumers whose employment continued reacted, fearful of possible future job losses and losses of asset values because of the financial downturn. I had friends who were very secure financially, who were living on pensions from the government or something where you knew that nothing could happen. And they too cut back, saying, well, I'll make my car go another year, or thank goodness I bought all these things because now I'm really cutting back. And I think everybody saw the same thing, that there was just a general pullback because of uncertainty, not only because things were not going well for some people. So the financial panic intensified the drop in consumption that would have resulted anyway from increasing unemployment because of the construction difficulties, while the normal drop in consumption intensified the panic. There was a significant danger that the panic itself could become a self-fulfilling prophecy, and in addition, the nasty surprises as the downturn progressed seemed almost to come every time there was some restoration of a little bit of confidence. Bear Stearns, the fate of the two large government-sponsored enterprises, Fannie Mae and Freddie Mac, both of which underwrote the mortgages, AIG, which I already mentioned, the largest insurance company, and finally Lehman Brothers. These did not happen all at once. You just about got over Bear Stearns, and the next one happened. You just about got over Fannie and Freddie, and the next one happened. And there were these bad surprises that just seemed to keep coming, which intensified what was going on. They seemed to happen almost at regular intervals, so people began to wonder when and what the next big negative surprise would be. It can even be argued, and I'll come back to this a bit, that the Greek crisis of the winter and spring of this year was another nasty surprise in many ways. So let me now turn to the upturn. The panic abated as the authorities took measures to increase liquidity in the financial system and undertook stress tests to reassure all as to the financial health of the banks under the Troubled Asset Relief Program, called TARP by its initials. Simultaneously, a stimulus package of huge proportions was voted by the American Congress. For my purpose, I need to highlight two features of that package. First, several of the measures taken provided incentives for consumers to accelerate their expenditures on big-ticket items, housing and cars in particular. Second, the increase in government expenditures greatly increased an already large fiscal deficit in the United States. In the stimulus package, among other things, Congress voted monies to finance subsidies to consumers buying automobiles, which, and by the way, that happened in a number of other countries too. The U.S. wasn't alone in that. Likewise, there was a significant credit, $8,000, for first-time home buyers. Both of these measures were time-limited, and consumers knew when each measure would expire. The predictable and inevitable result, a consequence of these measures, was that some consumers who were considering buying a house or a car over the medium term decided to buy while the subsidies were still available. It was only to be expected that when the subsidies ended, there would be some drop-off in demand. And remember that when you see the housing numbers for August and September and so on in the U.S., because the subsidies ended in June. The auto comparisons of sales this year and last year are again tainted by the fact that last year it was the end of the subsidies coming, and so people were rushing to buy before they ended. The subsidies undoubtedly contributed to the strength of the upturn. So too did inventory restocking, with a degree of alarm about economic prospects diminished. Just as the panic had induced a sharper than usual drop in consumer spending, the return to more normal expectations led to a greater than usual increase in spending when it became clear that economic activity was starting to pick up and that you didn't have to be afraid that you wouldn't get a check next month. Partially offsetting this was a continuing concern about aspects of the financial system. On one hand, financial balance sheets still needed repair. On the other hand, consumers had dissaved considerably during the upswing, and it seemed clear that they too would need to increase their savings rate. And they've done so. From zero or negative savings out of disposable income, American consumers have raised their savings to the rate of 4 to 6% of disposable income, and possibly even more as we speak. which won't sound like very much to Koreans in this audience, but relative to -4% and -3% in the United States several years ago, it's quite a big change in saving behavior. There was and is considerable uncertainty about the future course of personal saving. Will consumers go back to their old bad ways? Will they, once they get a little bit of saving and pay off some of their credit card debt, will they go back to zero saving? What will happen? This is an uncertainty, and of course, no one knows the answer. On the other hand, each quarter in which consumers do save 4 to 6% or more of their disposable income means that consumers' balance sheets have started improving. Their debt is down, and they're in that sense better off as they've reduced their indebtedness on cars, credit cards, and even in some cases their mortgages, although some of the latter have been in the form of defaults and repossessions, which of course is different. On the other hand, given the losses taken by consumer and the value of their houses, their holdings of equities and other financial assets, it is not possible to estimate with any confidence the likely rate of saving or the desired level of assets relative to income at this time, which is another source of uncertainty. And some economists are convinced that saving will stay high, others are convinced it will drop again, and depending on what you think, your outlook for the future varies to some extent. Until this past summer, the forces for rapid recovery, reduced panic or even confidence, incentives to buy durables early, inventory restocking, stimulus expenditures of the government, and so on, clearly outweighed the negatives. But as the incentives for early purchase disappeared, and the initial, relatively sharp turnaround in consumption expenditures petered out, the expenditures under the stimulus package reached their peak and have begun to decline. That, too, has contributed to the slowdown. Slowdown is not a slowdown in the sense of reducing economic activity, but it is a slowdown in the rate at which output is increasing in the rate of recovery. Some momentum has quite obviously been lost. But to confound matters further, there are some other developments that make it even harder to interpret the picture. The American census, which is held every 10 years and must be held by the Constitution, was held in the spring of this year. And to undertake the census, the government hires an additional 750,000 or 800,000 workers. 750,000 workers are hired temporarily from late winter until late spring as they go from door to door, checking up on the people who didn't get their forms in and doing the other things that need doing. As those government workers were released when the census taking was complete, i.e. in June and July, mostly in August now, the number wasn't as large enough to affect the overall employment numbers. The private sector's additions to employment were almost completely offset by reduced government employment. So the overall unemployment percentage remains about the same. Employment has been going up, and of course labor force is growing somewhat, but much of the increase in the private sector's payrolls has been offset by a decrease in the government with the census. Now, temporary layoffs of workers who knew they would be temporary probably don't have the same effect as layoffs of workers who expected to keep their jobs. If you took a job with the census to go around door to door to find out who was there, you did not expect that stream of income to last forever. It was a temporary thing. Whether the negative effects of those layoffs will be the same as the negative effects of more general unemployment is another question that we just don't know the answer to. It's one of the questions overhanging right now in terms of uncertainty. While the United States is important, it is of course not the only country. In 2006 and 2007, there was considerable debate, as you may remember, as to whether developing countries, especially emerging markets, had, quote, decoupled, unquote, from business cycles in industrial countries. The word decoupling was meant to convey the idea that other countries might not be very much affected by downturns in industrial countries. In the event, of course, they were affected. On the other hand, emerging markets have emerged very strongly, in most cases, from the recession. The fates of different countries have been quite different, depending on their initial fiscal position, their initial indebtedness, and the composition of their trade. China was seriously affected by the drop-off in export demand, but was able to undertake a major stimulus package of public expenditures because of her very favorable debt and reserve situation. India was less affected by the downturn in trade and needed less stimulus, which was fortunate given the fiscal situation. In fact, the Indian economy was overheating at the beginning of the recession, and in a way the Indians were a little bit lucky that something came along that gave them an excuse to take off a little bit of the pressure. Those large countries, Indonesia, and most other South and East Asian countries were seriously affected by the initial drop in export demand. But as inventory restocking started and domestic measures were taken, they have contributed to global demand and they have contributed also to offsetting the deflationary forces in the global economy. Singapore is perhaps the most dramatic example, as you may know, where real GDP in the second quarter this year is estimated to have been 20% above real GDP in the second quarter last year, as export orders have come in again. Very badly hit, but coming up very quickly too. And this has happened to several other countries. Japan did not initially experience a major downturn, but has not to date been able to sustain growth, as you know. But the major concern has been and is Europe. The recession hit hard, in part because many European banks incurred large losses on mortgage-backed assets and other financial products generated mostly in the United States. Some countries, Germany and Scandinavia, for example, were not so hard hit because their banks had not gotten so exposed and the housing boom was not so much of a factor there. Others undertook expansionary fiscal and monetary policy. Fiscal deficits, which were already sizable in some countries, and I have the United Kingdom in mind, exploded. For some, including Ireland, Greece, Spain, and Portugal, sometimes referred to as the pigs, existing levels of debt in the euro area made those large fiscal deficits very dangerous, and spreads on their debt began rising sharply. Ireland undertook deep fiscal retrenchment, as did a couple of others, in time to avoid an approaching crisis. However, by January 2010, it was evident that some of the southern European countries in the Eurozone were confronting imminent fiscal crises, and they could not do what had earlier been done in such situations because devaluation within the Eurozone was not seen to be an option. The Greek situation made the headlines, of course, but there was fiscal retrenchment as well in the other southern countries when they saw what was happening to spreads on Greek bonds and so on as a result of the Greek situation. The Greeks ultimately, but only after 5 months, received support from the European Union and also the IMF, and undertook fiscal retrenchment, or started to at any event. And to date, that has enabled them to service their debt and even enter the markets a little bit for new funds, although spreads are significantly greater than they were a year or two ago. Most economic analysts point out that on the optimistic Greek plans, and they do seem to be optimistic, Greek debt will nonetheless reach about 150% of GDP within a year and a half's time, at which time the financing package from the IMF and the European Union will most likely have been used up, and many analysts are saying that at that point some sort of restructuring will be necessary. That raises uncertainty for Greece, but also for Spain and Portugal, who have not the same and perhaps not quite as severe, but similar difficulties. And that is casting something of a pall over Southern Europe, raising questions to some extent about the euro area as a whole. Now, in the period before the European Union and the IMF acted, there was considerable uncertainty about the future course of the Eurozone. This resulted, among other things, in a significant depreciation of the euro relative to the dollar. You may recall that the exchange rate was about $1 to $1.30, or $1.32 or $1.33 per euro, and the U.S. dollar appreciated until it was about $1.17 to the dollar. It's now back to about $1.28 as things have moved around, but it increased its uncertainty on international markets more generally. The events in Europe have no doubt contributed to the loss of momentum and recovery, both because of uncertainty and because of the effects of dollar appreciation on the U.S. economy. The restoration of more or less stability in the short run in Europe is no doubt a positive factor. How great that will be and for how long remains to be seen, and clearly people are aware of that. In the most recent national accounts data indicate that consumption spending in the United States rose 2% in the second quarter, which is a very large increase, 8% annual rate plus compounding. But half of those 2 percentage points, i.e. 1%, went to imports. How much of that is the result of dollar appreciation, and how much is a more permanent trend is an important question. And I'll come back to that because it raises questions over the longer term about U.S. balances, Chinese balances, and all that. I did note earlier that there were two major effects of the stimulus packages undertaken in response to the Great Recession. The first of these was the increase in spending by both government directly and by private individuals as confidence was restored and because of time-limited incentives. The second was the sizable increase in fiscal deficits. Countries such as Greece could not increase fiscal deficits because of their heavy initial indebtedness. But other countries could not increase any more than they already had. But other countries such as the US and the UK were able to increase indebtedness, but at a cost of sharp increases in their debt-to-GDP ratio. These increases raise questions about the longer-term economic prospects, and I will discuss those issues later. But even in the short run, the high indebtedness raises concerns. There are concerns that worries over indebtedness may itself induce consumers to fear for the future and hence rein in spending, and may be one factor pushing up current savings rates. But more are worried that debt servicing could raise interest costs and indeed lead to inflation unless credible measures are undertaken now that give assurance that fiscal deficits and the debt-to-GDP ratios will peak and start to fall in the intermediate term. While few in the US or Europe are advocating immediate reductions in fiscal deficits, many are urging time-bound commitments that provide confidence that deficits will be reined in. That, of course, removes any scope, or removes most of the scope, for any additional fiscal measures should the pessimists be right in terms of going forward. And there's very little more I can say than to say that it removes that scope to a large extent. There are many questions as to the force of these concerns in the short run. But there is little doubt that debt-to-GDP ratios must be stabilized in the not-too-distant future, or the consequences could be serious, and I'll come back to that. So now let me turn to the short-term outlook. It should be evident from what I've said that the momentum of recovery has slowed in the U.S. The revised rate growth for the second quarter, the annual rate is 1.6%, and in early green reported as 2.4%. In the global economy, there seem to be some offsets. The major European economies seem to have been expanding at rates greater than those anticipated, Germany particularly, and the outlook for most Asian economies, except Japan, remains very positive. If anything, Asian economic activity seems to be increasing at an accelerating rate, and it's the United States that is the critical question. And for the United States, the issue is whether the recovery will stall with the economy falling back into recession, i.e. the double dip, or whether the slowdown is the result of the unusual combination of factors that led to the sharper acceleration, plus those temporary factors I mentioned. In that case, it may be expected that growth in the second half of this year will be slow, perhaps at an annual rate of 1 or 1.5%, and accelerate a bit thereafter. So far, the balance of the evidence suggests that output in the United States will not fall, and that a double dip will be avoided. But there's more downside risk, especially if there are any more negative surprises, and every time we think that things are going well, there has been another one so far. But so far, while there's more uncertainty than is usually the case at this stage of the recovery, in part, that uncertainty itself is endangering and slowing down the recovery as people are hesitating because of it. Reports of a drop in house sales from a year ago, for example, are taken as negative news, which of course they are, but how much of the drop is the result of abnormally higher sales earlier in response to the incentives is what is not clear. So how to interpret some of this slowdown is very, very difficult at the present time. But because growth is slowing, the economic news is mixed. One week, the number of newly unemployed workers registering for unemployment is down. The next week, it is back up. Average hours worked rose for several weeks, which is normally a sign that employment will rise, and then it fell again, and so on. This week, the news is that credit card delinquencies in the U.S. are falling. That normally doesn't happen until after unemployment starts falling, but it's happening earlier, and nobody knows why. All of the normal signals seem to be a little bit out of sync, and it's very hard to know what's going on. And bad news seems to get more press than good news, which itself probably contributes to the slowdown. Last week there was a headline about how housing prices had fallen in the United States in whatever was the preceding period. And then you went on to read the article. There are 36 metropolitan areas of which they were reporting. And the article basically said that in 18 of these 36, housing prices had risen. In 14 of these metropolitan areas they had fallen. In 4 they remained unchanged. The headline was that housing prices fell. In fact, on average, they rose about 0.5%. But the fall in the 14 metropolitan areas was what made the headlines, and for many people is what influences their outlook, and therefore things are somewhat pessimistic. There are some positives for the U.S. at the moment. Among them, the depreciation of the dollar after its appreciation during the Greek crisis is, I think, good news. There's also some evidence that the actual fiscal deficit may be somewhat smaller than expected. Apparently because tax revenues have not fallen as much as anticipated, which again is consistent with real incomes holding up more than we thought. And it would imply more economic activity than was factored into the forecasts. Financial institutions are improving their balance sheets, have reported high profits, much of which have gone back to restore equity, although the expansion of credit has been at a slower rate than expected. Everything you can say that's positive, you could find something that's negative, and vice versa. I will talk about the reform of the financial system now until I get to the longer-term outlook. On the negative side, unemployment remains stubbornly high, about 9.5%, 9.6%. Payrolls are evidently rising, but that's because the labor force is growing and unemployment rate is not rising. And consumption seems to be increasing. I already mentioned that. Nonetheless, the fact that many people are unemployed, and there's more longer-term unemployment than there has been in the United States, and the payrolls are not rising more rapidly, adds credence to the view that growth is slowing at the moment, which it almost surely is. Balance sheet concerns are still an issue, and while the rate at which the number of foreclosures on homes has slowed, the total number of foreclosed homes remains high. Many of these people paid no down payment. They got a subsidized interest rate and couldn't afford the payments even when they were expected to start paying any interest at all. But there is no basis to believe that residential construction will be a significant contributor to U.S. growth for the next several years. There's too much of an overhang on housing stock. The most that can be hoped is that it will not be too much of a drag. On balance, I think the outlook is still positive, even if it's not as positive as you'd like it to be. Goldman Sachs last week put the odds of a double-dip recession at 30%. The IMF is continuing to assert that output will keep rising, although not as rapidly as might be wished. And I would guess that we will see the second half come in at a rate of growth of 1 or 1.5% annual rate. But it is more uncertain than many of the kinds of numbers that one likes to give when giving this kind of an outlook of presentation. It's just too difficult. But let me now turn to the longer term. With a relatively slow recovery that could be expected in the U.S., fiscal and debt difficulties that Southern Europe continues to face, and the apparent sluggishness of the Japanese economy, the really bright spot of the global economy for the next years continues to be Asia outside Japan. The main Chinese problem is the risk of overheating. Indian economic growth seems set to accelerate somewhat, and Southeast Asia, and especially Indonesia, look to be sustaining growth. Europe looks mixed. Germany is doing better than most people thought. France seems to be doing okay. Even the UK is coming in slightly above forecast, as is Scandinavia. But on the other hand, the Southern Europeans and Eastern Europeans still have difficulty. If the U.S. economy continues growing, as I suggested, for the next half year and then accelerates, that would also add some momentum to world economic growth. But assuming that that's right, and the uptrend continues more or less satisfactorily, there will still be a host of longer-range problems. These center around the interrelated concerns of fiscal consolidation, debt levels, and demographic trends going forward, the international trading system itself, the stability of the international financial system, and global imbalances. And those four things ought to be enough to give us all a headache. Turning first to fiscal demographic issues, we've all known for some time that the industrial countries' populations are aging, as is Korea's, as is China's, and a few others, and that the fraction of the working age population is set to fall. That's already begun, of course, in Japan, and most European countries are confronted with almost immediate demographic issues. The U.S. has another 5 or 8 years or something like that before it becomes quite such a problem. The aging of these societies is going to place additional fiscal burdens on social insurance and health systems everywhere. There will be fewer workers per retired person, so the amount of taxes and pay-as-you-go systems that working people have to pay to support the elderly will rise. At the same time, many of these countries have very high debt-to-GDP ratios already, and simultaneously must cut their fiscal deficit sharply once recovery is underway. And that will present a very significant challenge. In the United States, the problem is not as severe as in some other countries, but even in the U.S., it is estimated that at full employment, the fiscal deficit on current spending taxing plans is about 7% of GDP, and the increasing fraction of the elderly would add another 1 to 2 percentage points to the fiscal deficit before 2020. Hence, credible fiscal consolidation in the United States on the order of 8 to 9% of GDP is needed if the debt ratio is to be contained. And that is a huge number. It's already set to be reaching 90% debt to GDP by the end of the next fiscal year. The U.S. debt is rising, and everyone, I think, agrees that measures must be taken, if not this year, but measures must be taken that everybody knows will be taken in order to make it credible that this will not keep happening. The fiscal challenges of the major European countries and Japan are even more daunting, as debt ratios are as high or higher, and the demographic shift is set to be even more pronounced. For most countries, the debt burden would become increasingly heavy over the next decade unless action is taken. It's difficult to know in any country when the situation will change from heavy, in quotes, to crisis. That would vary from country to country depending on expectations, past records of the countries, and all the rest of it. It will certainly depend a lot on how market participants view the country's future fiscal deficits. If it is believed that measures are or will be taken to address the problem, it's very likely that the country could avoid major difficulties. If, however, fiscal deficits are not addressed, so the debt to GDP ratios will continue to rise, creditors will become increasingly unwilling, as they were in Greece until action was taken, to roll over or extend credit. As they do that, spreads rise. As spreads rise, the growth rate falls. As the growth rate falls, the debt to GDP ratio rises even faster. A vicious circle can set in, and it can set in quickly. So a lot depends on the behavior of governments in individual countries. The Greek experience certainly spurred some other countries to take some degree of the necessary measures, even though they're very politically difficult. Whether the lesson will have been learned well enough by other countries will determine how they will fare in the intermediate run. Almost all industrial countries must rein in their prospective fiscal deficits. They depend on three things: the debt to GDP ratio, the magnitude of the prospective deficits in the absence of action, and finally the growth rate. For the higher the growth rate, the less fiscal consolidation will be needed for any given trajectory of expenditure and tax plans. But achieving higher growth almost everywhere requires structural reforms, most of which take several years before the results show up in the higher growth rates. Right now, Germany's growth rate is surprising everybody a bit because it's higher than expected. The reforms that were undertaken in Germany were undertaken in the period about 2003 to 2007. It's been several years before they feed into higher growth, but that is helping the German economy quite a bit at the moment. So higher growth rates themselves would ease the difficulties of fiscal adjustment and reduce the required degree of austerity. So it's in everyone's interest that structural reforms be undertaken earlier rather than later to make the growth rate higher in order to make this whole process, which will be hard no matter what, easier and perhaps even possible. There are several actions that can improve growth prospects globally in addition to the ones that individual countries need to take. The most important of these, in my judgment, relates to the protecting and strengthening the open multilateral trading system. Some have argued that it's encouraging that there were not more protectionist measures taken during the downturn, and that the fact that countries didn't do worse shows the respect that individual countries have for the system. And there's some truth to that. However, as Simon Evenet, who keeps track of all these things, has documented, from the G20 countries alone, there were over 400 measures that he classified as protectionist, taken in the year after the leaders of the G20 all pledged that they would take no protectionist measures for a year. 400, over 20 countries. You can do the math. Some countries, of course, were worse than others, but I think there were only 3 countries that took none. Provisions in stimulus packages to buy national cars, for example, were frequent, and they are protectionist. Several countries raised tariffs, but kept them below the high boundaries, also basically protectionist in meaning. Perhaps the most important thing the international community could do to enhance growth prospects would be to complete the Doha round of multilateral trade negotiations. The round, as you know, has languished for several years, and the absence of official support for its completion has served as a signal that governments would countenance more protection. Yet the open trading system has been the backbone of the era of unprecedented growth the world economy experienced in the half-century since 1950, and certainly, as was discussed yesterday in the 60 years of experience, that open trading system made it easier for Korea to grow as rapidly as the country did, which would not have been possible had the trading system been in worse shape. Reaffirming the importance of the trading system, strengthening the multilateral system, would itself serve as a spur to growth. I keep hoping that some of the countries that have a huge interest in the open system, Korea, Japan, China, India, and a few others, could possibly get together, state their interests, take some leadership, and begin pushing the industrial countries to do what they ought to do, and which they at the moment are not doing, and taking leadership themselves. Another international issue that cries out for resolution is the matter of global imbalances. That, as you recall, was the term of art, or phrase of art, used to describe a situation in which China ran a large current account deficit, or surplus, which was financed by the U.S. running a large current account deficit. There were a few other smaller countries, but it was basically China and U.S. just because of their size. In a way, you could say that China was an enabler of the U.S. fiscal profligacy, and the U.S. was an enabler of the Chinese high propensity to save. And as the U.S. accommodated a large part of China's current account surplus, and China accommodated a large part of the U.S. current account deficit, the U.S. became the world's consumer of last resort, as it was called. But the reserve holdings of the Chinese and the U.S. debt are now sufficiently large that a repeat of global imbalances would be dangerous indeed. There needs to be some kind of a mechanism devised internationally so that agreement can be reached on what appropriate measures for containing the degrees of deficit and surplus might be. And that's a very difficult thing to achieve. The surplus countries agree that something should be done, but they think the deficit country should make the adjustment. The deficit countries agree something should be done, but they think the surplus country should make the adjustment, and nothing happens. With global imbalances, the inflow of funds to the U.S. resulted in very low real interest rates. Those low real interest rates, in turn, contributed significantly to the real estate boom and the financial weaknesses that triggered the Great Recession. The countries with current account surpluses and those with current account deficits all agreed they were unsustainable, but of course, as I said, each thought the other side should adjust. There has been little serious action to try and prevent a recurrence of global imbalances. The G20 agreed that peer pressure would be tried, but it's had little effect to date, and the recent figures show that U.S. trade and current account deficits are beginning to rise sharply again, and some of the more protectionist senators and congressmen in the U.S. Congress are now beginning once again to talk about introducing more protectionist measures, tariffs on imports from China, and other things that could very quickly have very negative effects for us all in the international trading system. If global imbalances are not successfully addressed, there will be one of two possible outcomes, both reducing prospects for world growth. The first possibility is that there would be another crisis as low real interest rates spurred another round of investment, followed by bust. The second possibility is that the influx of imports amidst domestic unemployment would intensify protectionist pressures, leading to further weakening of the open multilateral system, and hence undermining growth prospects that way. Either of these outcomes would have highly negative results for the global economy and its growth prospects. And that, in turn, would make the needed fiscal adjustments all the more challenging. The last major issue that bears on long-term global economic prospects is the international financial system itself. Unlike the trading system or global imbalances, where there has been little meaningful progress, there have been reforms in the international financial system. These include the progress made in changing the governance structure of the IMF to better reflect the realities of the international economy today, although more progress is needed, and moves to adopt a revised Basel set of banking standards and financial reform bills in individual countries. That the governance structure of the IMF should be changed is widely agreed, and is happening, although very slowly. The activities of the IMF are an important public good, and it is to be hoped that all countries recognize the importance of maintaining the integrity and capacity of that institution, and make sure that the fights over who gets how much more share do not have sufficient damage to undermine its credibility. Little comment needs to be made about the revision of the Basel standards. Those changes are needed, and they seem to be going in the right direction. Short of 100% reserve banking, nothing can make this banking system 100% safe, but the move to Basel III will close a few of the possible routes by which banks can get the system into systemic difficulties. Financial reforms have been enacted into laws in several countries, and they are generally thought to be a move in the right direction. But most observers note that the issue of banks that are too big to fail, quote unquote, which is of course the issue of moral hazard, And that those banks then taking on too much risk does not seem to have been addressed. Moreover, there are some questions as to how far some other reforms, such as the U.S. Congress's measures intended to prevent banks from trading on their own account, will go in correcting the underlying problem. So while there has been progress in that regard, it may not be as much as would be desirable going forward. At a deeper level, if some countries require their banks and other financial institutions to hold more capital than others do, this would automatically bestow an advantage on the banks in countries with the laxer requirements. This is not an argument for lax banking requirements everywhere, but it is an argument for attempting to agree, at least to some extent, on global standards. Such standards would cover not only capital requirements and risk ratings, but also procedures to be followed when banks with owners in more than one country get into difficulty, and other questions that arise when more than one country is involved in the regulation of a given bank. Even if all these measures were taken as best they could be, appropriate fiscal consolidation, policy reforms, completion of the Doha round, measures to address global imbalances, and proper coordination of financial regulation, and I've a dreamer to even think it might all be done. Even if all that were done, it seems certain that the international economy will again, someday, be confronted with another crisis. This is part of the process of economic growth as other things happen. But if actions are taken soon, that day will be further off, and the next crisis will be less costly than if we do not learn the appropriate lessons from the current one. Let me finish by talking a bit about the relevance for Asia. As you know, Asia's had a, quote, good crisis, unquote, in the sense that the economic downturns were rapidly reversed in everywhere but Japan, and were generally either fairly mild or almost non-existent. Some countries avoided even a single quarter of negative economic growth, and the upturn has been more rapid and sustained than in other parts of the world. To a considerable extent, this demonstrates the strength of the Asian economic policy frameworks within the individual countries of the region. That debt to GDP ratios were low enabled most of the Asian countries, and certainly Korea, to increase public spending as needed to offset the headwinds that came from abroad. That reserves were high ensured that financing difficulties would not be encountered even when government expenditures were increased. With economic growth, it is certain that new economic challenges will need to be confronted and appropriate policy measures taken. In the case of East Asian countries, the demographic shifts of the coming decade are one visible challenge that will arise. Those countries with fiscal adjustments that must be made, most notably Japan, will confront the biggest problems in this regard. But others will also need to confront increasing labor shortages and greater drains on the social insurance systems as population age. In that regard, increasing the flexibility and mobility in the labor market will prove crucial. Other issues, such as environmental concerns, must also be addressed, but that too can be achieved more readily in the context of healthy economic growth. Moreover, despite the apparent decoupling that was seen in the most recent crisis, it remains strongly in Asia's interest that the open multilateral system remain a linchpin of the international economy, and that the global economy experiences healthy, sustainable economic growth. One of the lessons of the past 2 centuries is that much of our economic prosperity has come, for all of us, from increasing interdependence. With appropriate policies at the level of the individual countries and for the global economy, the outlook for the coming several decades can be for continuing integration, increased interdependence, and sustained, if not even more rapid, healthy economic growth. Thank you very much.
But I think her speech clarified a lot of things that recently Bernanke studied the current state of the U.S. economy as unusually uncertain. And I think she has covered a lot of things, so you may have a lot of interesting questions. But the problem is that she has very little time to spend here because she has to leave from the airport to catch a flight, no flight. She has to chill out, repack, and go there. So we have very precious 20 minutes time, and so you have to be a little bit restrained your question time. So limit your question or comment in 2 or 3 minutes at the most. Where China buys U.S. goods and export the money buy the U.S. credit bonds and so on. And the question is that when do you think China will stop or reduce investing their money in the U.S. buying U.S. credit bonds and so on? And how do you think the U.S. will react to change Chinese policy about buying these U.S. bonds? And the last question is, what do the rest of the world have to prepare against this changed relations between China and the U.S.? I think this question was already partly answered in your speech, that if this unbalanced situation goes on, then we may have a lot of crises in most of that, and already, and the protectionism will go out. But besides that, what kind of things you can say about it?
Well, first off, it's a very good question, and a lot of people are thinking about it, both in China and in Washington and everywhere else, I guarantee that. Keynes is quoted and said quite famously, if you owe your bank $100 and can't pay, you have a problem. If you owe your bank $1 million and can't pay, your bank has a problem. Well, in the case of the U.S.-China situation, the trouble is that the U.S. owes China many millions of dollars. And in that sense, it is not in China's interest to do a very drastic change of any kind because they would lose greatly. So in a sense, the Chinese well know this. So they are, and they have been, to some extent, reducing the increase in their holdings of dollar-denominated assets. But they have not reduced them. They just simply have reduced the rate of increase. And for a while, I think that's probably what they will do because that's their best strategy. There was something in yesterday's paper, I didn't have time to read it, about trying to make more arrangements so that countries could, people could, importing from China could pay in renminbi rather than paying in foreign exchange for their imports from China. I'm sure they will work on more such arrangements. China is growing economically, and if that growth is sustained, it will become more important and the trading systems play a larger role, and we're bound to see a bigger role, therefore, than the Chinese currency. But to do that, of course, they have to do a lot of things, including, of course, opening up currency convertibility there, which they have not done yet.
Okay. Now, let me call the question from floor.
Junior Kim. Good seeing you, Dr. Krueger. This is the third time I see you lecture here on this same forum. Always impressed by your breadth and depth of your coverage, particularly at the pace, probably twice the pace of any other authority. Of all the areas you covered, I would like to ask questions on the 2 areas which have really significant impact on the economy, that is housing and the consumption. First, the housing. You raised a very serious question as to citing the Australian success, whether the monetary authority should step in time to curb the rise at a very rapid pace of the price. But even beyond that, I'm very much puzzled by the allowing of the subprime mortgage in the United States, which is clearly built on the mechanism of the continuing rise of the price, which can never be sustained, and how that, in the eyes of the regulators of the banking authorities in the United States, we close their eyes on that is something I'd like to ask your opinion on. Second part is consumption. You touched on this time, one of the breadths, because consumption was also severely affected. Usually, consumption is the more stable part of the economic spending because much of it is life necessity. But due to the recent affluence, particularly in the developed economy like the United States, increasingly smaller portion is life necessity in consumption. Do you think that has also a lot to do with, besides the fact that the funding source of the rising equity vanished, the very necessity of buying the things has also diminished?
about how could this subprime mortgage thing have happened. And as I'm reading them, to my astonishment, it's turning out that this, what I thought was relatively harmless, i.e. the packaging, I thought made sense. You package the mortgages, and then you put people who want less risk but get a package which has the first and second year payments and so on down the line. Turns out that the people who were buying those, and even the people selling them, did not know exactly what they were doing. There does seem to have been an incredible amount of incomprehension, more than I would have thought possible in all of this. And I even know people who are friends of CEOs of some of the large banks that got involved. Apparently there were even contracts as to what the banks would buy back in the event that something went bad. And the CEOs themselves did not know that there was this buyback provision. So it does seem to have been more of a failure within the banking system than I initially thought. The Congress did mandate in 1997 under something called the Equal Opportunity Housing Act. The banks had to lend a certain part of financial institutions that were in the mortgage business had to lend a certain fraction to poor people. These are the subprimes. So Congress was not innocent in this either. And at first I thought that was the big problem, but it turns out it's a double problem with this other business. Housing prices had been rising for 50 years in the United States, and some people seem to have thought that that meant they would go on forever. But it turns out that in some of these collateralized debt obligations, it took a delinquency rate of only 7% to bring the whole thing down. And the interesting thing about that is you calculated the odds on any reasonable actuarial basis. With many of these subprimes, it was well above 7%. There's a wonderful book now called Big Short by Michael Lewis, who describes how these guys thought they were doing something different than they were doing and were surprised when it came back to bite them. And it reads credibly. So it is a big mess, there is no doubt. And it's a worry. As to consumption, I think you're quite correct. Consumption is not as stable as it was because so much of it is discretionary. The other thing that's been interesting to me is anecdotal. In the papers you read about this poor family where he lost his job 2 months ago and she lost her job last month. And they've been spending everything. And even their course. The idea that they shouldn't save anything at all in any precautionary way for a rainy day does not seem to have occurred to many of the younger people. In the U.S., I'm still in the generation where my parents knew all about the Great Depression. And to me, the idea that we would behave this way seems very silly. But for the younger people, where there's been affluence all their lives, there seems to have been two parts. One, most of what they spent was discretionary. And two, they didn't try to save because they saw no reason. So I think all of that has run in there, and consumption is more unstable for all those reasons.
Dr. Krueger, as usual, I really enjoyed your very comprehensive and in-depth analysis. You pointed out that the importance of the open multilateral trading system. I know that G20 leaders instructed the trade ministers to come up with some specific action plans on the Doha round by the end of this year. Well, although you mentioned that Korea might take some leadership with some other Asian neighbors, but that's not enough. The most important thing, how the US and the European Union and India and Brazil, they have all different views on this matter. So my question is that what is the likelihood the G20 leaders can hear from trade ministers by end of this year on the Doha round? And second question, well, I know that you are a long time the advocate on the open trading system, but as far as Korea is concerned, we've been pushing through very hard a diverse free trade agreement. My question is that how do you see the possibility of the ratification of the U.S. Congress after midterm election on the Korea-U.S. free trade agreement? Thank you.
Yeah. But whether that something is meaningful in terms of pushing the Doha round forward is another question. I mean, they're going to come up with a communique that says we can discuss this and that, and we'll do this and that. But whether that moves things forward, I don't know. The one thing I would question in your comment was, it seems to me that India now has exports over 20% of GDP. Even 10 years ago, they were like 7%. China, of course, is hugely dependent on exports. Korea is hugely dependent on exports. Indonesia is reasonably dependent on exports. I don't understand why there couldn't be an initiative from Asia, maybe even persuading Brazil, who's dependent on exports to go along, maybe Chile, maybe some other countries, and get a large and careful statement from the leaders as to the importance of the round, and go and hit leaders from the industrial countries over the head. The U.S. tends to blame the rest of the world, saying, look, they're all protectionists. Well, so is the U.S., if you want to know the truth. But the U.S. doesn't know it. And I think people in the U.S. also don't understand how important the trading system is for poverty alleviation and all that. And I do think that the U.S. has been, and I'm proud of it, a reasonably good, not perfect, but a reasonably good leader over the 50 years since World War II. But its leadership has been faltering now, and maybe some push from somewhere else will help. I don't know, but that has to be my hope. The U.S.-Korea free trade agreement. I don't know. That's all I can tell you. I simply don't know. Quite clearly, President Obama said he would be invited again, but he also said he wants to renegotiate. And once he says he could renegotiate, he could put anything in there, and it's not clear to me that Koreans would accept what he puts in. It's not clear to me what it would be, and so I don't know, and you don't know whether it should be acceptable. I think if ever there was an agreement reached by his administration, he would then be able to push it through Congress. But I am not convinced that the agreement that by trying to renegotiate, remember he promised all those Michigan workers, auto workers, jobs during the campaign, and things like this, and he's a little bit hungry. And how far he's willing to go, I just don't know. And I don't think he knows. I think he hasn't focused on it. He certainly was impressed with Korea. He certainly came away from G20 saying he wanted to do something on the free trade agreement. By the way, the Korean ambassador in Washington, the public finance minister, has been going around the country and been a quite effective salesman for the free trade agreement. So some work is being done, but whether that will be enough, I can't tell you. A lot depends, I think, on the state and local imbalances and on the extent of the recovery. The stronger the recovery, the less the China-U.S. friction increases, and more likely it is to go over.
Professor Krueger, all of us know last year, September, at Pittsburgh, generally agreed between among G20s about the rebalancing of such a very troubled imbalancing to improve. That time, basic direction, U.S. side, they increase domestic saving and decrease trade deficit amount, and also increase some investment. And on the other hand, among G2, China, they recommended to increase their consumption, domestic consumption, and some of social welfare network, and also to decrease savings and so on. But when we see a recent U.S. situation, this goes somewhat different directions. So everybody expects some more treasury bonds purchased by the FRB, and also some of the mortgage-backed securities will be purchased and so on. And in that case, do you think coming November at the G20 summit, there will be some agreement, both US side and China side, the direction? China might insist that they have increased consumption through various taxation measures, and also they are expanding social network and these things. But the US side, so far, that will not be happen to recommended directions. So in that case, how do you see that both either US and China will be coming to cooperate and in a collective measures and to improve and obtaining some more better rebalancing? That's my question.
Then you said, remember, the savings rate in the U.S. is up 10 percentage points of GDP, which is more than China's consumption rate is up. So in that, if you use the measure of outcomes, you'd say the U.S. has done a lot. If you measure policies, you wouldn't say so. So there's something there. I think a great deal depends on diplomacy between the two countries, and I'm no expert on that. Quite clearly, the decision to allow the exchange rate to move a little bit was a decision that gave in to some degree of concern on that and should make a little bit of difference depending on how much they let it move. So I think that's one of the questions where what the Chinese think and what the Americans think will matter, and what is said by other countries at the G20 will matter greatly. So it's up in the air, and it's not a foregone conclusion either way as far as I can see.
I'm concerned about growth because it seems like we're getting a lot of structural reform in the U.S. I know the banking system has been undergoing repair. A lot of companies have cut down their debt. People, it's almost like we're spring-loaded in the U.S. for recovery, but without any growth, nothing's happening. We're not seeing, a significant pickup, and it seems like you're more sanguine about the drop-off, and you seem, I got from your talk almost that you seem to be a bit of a fiscal hawk, that we really need to improve our fiscal situation for future confidence and for a variety of reasons. But I'm concerned that with the drop-off in fiscal measures, with the stimulus package wearing off, it's no accident that we've seen all of a sudden a big increase in concerns about growth, and we've seen all these problems coming up since the spring, precisely when everything started to wind down from the stimulus packages. So, do you think that there's going to, there's any chance? You said no chance that we're going to see another round of fiscal measures, but then what happens to growth?
They cut their debt, they cut their fiscal deficits, and it's been pro-growth. And you could go through the OECD, and there are at least as many countries that have gotten growth stimulus as they were not. If the fiscal deficit rises, if the interest rate rises, it's bound to choke off. The only question is timing. I think everybody agrees you don't want to cut back too fast now, but there has to be a cutback over the 3 or 4 year time horizon. No cutback almost certainly means slower growth than would otherwise be the case. So the art and the difficulty is finding that window so that you let there be a gradual transition and so on. Now what I said was that I thought there'd be growth of about 1 to 1.5% in the second half. That's not harm, but it's also not zero. And most forecasters are saying that they expect a pickup coming in to beginning of next year, in part because of the fading out of all those negative factors that I mentioned that are impinging on growth right now. So I think that it's not true. The more stimulus always means more growth. Sometimes cutting the fiscal deficit means more prosperity. It's also not true the more stimulus right now would necessarily mean more growth even in the short run. There's a big argument about that. I think really right now, if there were another stimulus package, it would have to be, in my judgment, accompanied by a credible set of measures that were sort of put in place that would start cutting that deficit very quickly. That hasn't been done, and that, in my judgment, may even be part of the reason we have so little done.
Okay, already 10 minutes overdue. Then I assured her to when she can hear. So let me close this early session here. And thank you very much for joining us today. And thanks also for A Krueger. I wish she could come back next year to have sequel 3.
Thank you.